I'd like to spend a few minutes talking about retirement planning. As the baby boomer generation ages, we'll see more and more focus in the financial media about retirement planning and coming up with different systems to help us facilitate retirement plans. The most common conventional wisdom is that today you will take some portion of what you make, save that money into an account where it will sit and grow, and then you will retire at some point in time in the future, and you will go from man or woman at work to capital at work. Hopefully the idea is to build that account to the point where it's large enough that it can support not only you, but your spouse and your family and future generations with only the interest. Unfortunately, that's rarely the case. Okay? That's rarely the case because of a couple of things that aren't really focused on by the Main Street financial media. Number one, most financial planning software ignores the fact that there are variable rates of return that occur each and every year. It would be very easy for us to plan if we knew that the financial markets, the stock market, and other equity-based markets earn the same rate of return every year. As a result, most of the financial planning models assume an average rate of return. And unfortunately, money doesn't work the same way as math. Math is not money. What we see are incremental rates of return, and what ultimately ends up happening is that we have a situation where the volatility of the returns directly impacts the success or failure of your financial model. So in our next module, what we're going to focus on are variable rates of return. And we'll see that an investment can average 10% in two separate scenarios. In one scenario, there will be plenty of funds left over and the program is widely successful. On the other scenario, the investor actually runs out of money because of the fact that the sequence of returns was substantially different. As a quick example, let's assume you had $100,000 invested in an account. In year one, the account loses 10%. Now we have $90,000 in the account. In year two, the account makes 10%. Okay? So it's averaged out to basically zero. It was up 10% one year, it was down 10% the second year. In year two, because you only had $90,000 in the account, it made 10%, but now it's only gone up to $99,000. We didn't account for the $1,000 of loss. And what we end up finding is that if the negative years in the sequence of returns occur at the front end of the timeline, there's a much lower statistical likelihood that someone is successful than if they occur at the back end of that lifetime. What that means is that without any real planning, what you're subjecting yourself to is a voluntary birth year lottery in terms of whether and how your funds will grow and whether or not you'll succeed financially. Okay? So each one of us in the room is born in a different year probably. Each one of us has different amounts saved for retirement, and each one of us have different goals, aspirations, and income needs. Okay? Based upon when you decide to retire and how long you live, the sequence of those returns will impact each of us differently. What we want to do is help create some insulation around your plan so that over time you have the ability to participate in upsides of markets and to be insulated to a certain degree on market downturns. Okay? Historically, many people have tried to do this simply with an asset allocation model. An asset allocation is simply, it looks like a pizza pie. They take a pie chart and diversify different investments over different categories, designed to work and coordinate with each other in an effort to minimize risk. However, in years like 2008, the stock market went down, the bond markets went down, and even some money market funds broke the buck or became insolvent or fell below $1. So sometimes those programs happen. Okay? We do know one thing for certain. Markets go up and markets go down. Okay? What we want to do is create a strategy or a program where you have access to funds in down markets that you're not locked out of due to pre-existing parameters, such as 401k retirement plan restrictions, such as having your home equity locked up into a property in a declining real estate market, and so forth. So imagine two scenarios, and I'd like to talk for a minute about some additional uses of life insurance. Life insurance can be used also as portfolio insurance to help you minimize some of the ups and downs or the impact of the ups and downs in your financial portfolios. Let's take client one, for example. Client one is retiring age 65 and he has $1 million in his portfolio. Okay? There is no portfolio insurance in the program. He is, however, in a well-diversified asset allocation model that will move up and down with the financial markets. As we know, In 2008, if that investor were invested fully in the markets or even in a well-diversified market, their portfolio probably took a pretty big beating. The markets were way down, and that person's income, which was predicated on the interest of that account and a combination of interest and drawing down of principal, was significantly reduced. What ended up happening in 2008 is that many of the people who were invested in basic asset allocation modules panicked, okay? They pulled money out of those accounts, or they moved it off the table out of equities and directly into cash savings and CDs. There was no way for them to recreate income unless they rejoined the workforce, and they had no opportunity to recapitalize their pool of capital. The downside to that is that many of those people are still in a negative financial position because the portfolio never had a chance to heal. Number one, they pulled money out of an account that was declining in value. Number two, they didn't have an opportunity for that money to grow back to its original coordinates because of the opportunity cost lost with spending the funds that were needed to drive their lifestyle. Let's take a separate example. Investor 2 has the same $1 million of revenue generated and built. They've capitalized their pool with $1 million as well. They take $800,000 and put it into the same asset allocation portfolio as the first client. Okay? It's subject to the same wild movements of the stock markets, ups and downs. Additionally, they took $200,000 and they bought 2 separate permanent life insurance policies. They put $100,000 in policy on the husband, $100,000 in a policy on the wife. Okay? The internal cash values grew inside those policies, very similar to a bond fund. They had very similar rates of return to a bond fund, although it wasn't invested in bonds. It was invested in the insurance company's general account. Over time, that asset performed very similarly to some of these fixed income accounts. The sum was still $1 million. In the end, when the market went down, that investor had the ability to let the portfolio, the $800,000, heal and grow back to its original coordinates because they were able to tap into non-market correlated assets. They were able to tap into the cash values of these life insurance policies and utilize them to carry them through a year or two while the market healed. Gave them the ability to grow their pool a little bit better than the other person. They also had the ability to have a recapitalization feature built in. We refer to this as the retirement permission slip, okay? The permission slip to spend down your assets. We work with thousands of clients, most of which have a goal of building a pool of capital and then utilizing that capital to draw down over a period of years to supplement their retirement income. The biggest fears that they encounter are leaving their spouse holding the bag or unintentionally impoverishing their children or grandchildren. As a result, they work their entire life to save money, put it away, and hope that they're going to be financially successful, only to live a life as a pauper in retirement because they don't want to see their assets drawn down to zero. We've created a strategy for them to help recapitalize the pool. We did some extensive research on millions of Americans, and we found out one thing for sure. Everybody dies, okay, for certain. And what we want to do is make sure that there's an economic benefit associated with a death, okay? So imagine the second client now has the ability to utilize his cash values inside of his insurance policy as a recapitalization feature to allow his other money to be reinvested or to draw down those accounts. Additionally, they have another benefit that the first client doesn't have. Let's say the first client bought 20-year term insurance and it expired worthless when they hit age 50. They didn't think they needed life insurance. The second client had the ability to purchase permanent insurance, knowing full well that allowed them to spend down those assets. They spent down the waterline in their financial bucket, knowing that at the time of the death of the first insured, there was going to be an economic benefit. In addition to the $100,000 of cash values, they had $500,000 of death benefits that the insurance company was going to pay out. So if I died first, that bucket would refill with another $500,000 so that my spouse would not be left holding the bag. Conversely, if my spouse died first, the bucket would fill for me so that I would not be left holding the bag. And there would be an additional infusion of $500,000 of capital. Think about that from a retirement permission slip spending scenario standpoint. Think which client has the ability to spend down their assets more aggressively, knowing that there's a recapitalization feature built in. Which couple can take more trips? Which couple can spend more money on the grandkids? which couple can see the world, which couple can have less stress, less anxiety, and know that they're not going to run out of money because they've got multiple recapture positions built into their program. And then I ask you the question, would it surprise you to know that they could accomplish that simple move with virtually zero out-of-pocket outlay? A simple readjustment and shifting of the underlying assets from a bond portfolio to an insurance portfolio could, in many cases, accomplish all of these things. So again, we're not telling you that everyone should buy life insurance. We're just giving you an idea on how to utilize a coordinated approach to your planning to help you maximize your wealth potential.